Hey, everybody, welcome. We are so glad you are here today. I apologize for the small delay, as in the normal world of everything technology based. Sometimes the technology doesn't do exactly what you'd like it to do. So thank you for waiting it out for us. It is 4:06. You are going to hear very little from me, but we're going to get right into the meat of the presentation. I am Heather Fortner. I am the CEO of SignatureFD. And SignatureFD, we are the home of Net Worthwhile. We are a wealth management firm that believes in net worthwhile, and that net worthwhile is really the place where your wealth meets your worth. And we believe that your worth is really the culmination of everything that matters to you in life, and that your wealth really finds purpose when it is aligned to support your worth. We are so honored and excited today to have the two speakers that we have. So I'm going to introduce them, and then we're going to get right into the presentation. We do apologize. Dr. Kelly, you're not able to see his face, but he is on the line and listening. So you are going to get to enjoy Tony Welch's face the entire presentation. So you have that to look forward to. Dr. David Kelly, he is the Chief Global Strategist with JP Morgan. You have likely seen him on CNBC or in the Wall Street Journal or on other national investment stages. He has over 20 years of experience. He has served as an economic advisor to Putnam Investments, a senior strategist and economist at SPP Investment Management, and at several other places, big name places. I wish you could see his face. I wish I could see his face, but Dr. Kelly, thank you so much for joining us today. And then one of my most favorite people in the world, Tony Welch. He is the Director of Investments for SignatureFD. Tony has been with us about 3 years, and in that time he has transitioned from overseeing our portfolio strategy to really leading the team and directing the entirety of our investment platform. He also serves as the chair for our investment committee. Tony is a brilliant mind. He's one of the best investment communicators that I've ever known, and he is a sought-after guest for several media outlets as well. We're going to have a Q&A at the end. Tony will be able to see the chat, so as you have questions come up, go ahead and please enter them into the conversation window, and Tony and Dr. Kelly will address those as they go throughout the conversation. Again, I apologize for the delay on the front side, but thank you for sticking with us, and I hope you enjoy the conversation. Tony, take it away.
All right, thanks a lot for queuing that up, Heather, and Dr. Kelly. Thanks again for being here, and we definitely look forward to your insights today. We'll go ahead and just kick things off with kind of an opening, broad question for you. Let's really just kind of start with the state of the economy. You know, some of the data on housing and retail sales and industrial production today has been coming in pretty weak recently, but that looks like it might be weather distorted. Just what kind of shape do you think that the economic recovery is in today? Where do we stand today? What's driving it? And what can we expect out of the domestic economy, at least in the next 2 to 3 years?
Well, to be honest, the U.S. economy is kind of like an athlete at the starting blocks here on a 100-meter dash. I mean, the economy is not doing anything right now. It is rocking back and forth a little bit on the blocks here, but you're right. The weather did have something to do with both housing starts and new home sales in February, and also retail sales, although they were very, very strong in January. But I think the main point is that we're vaccinating, and we have about over 25% of the American population has now had at least one dose. And about 70% of people over the age of 65 have had at least one dose, and that is already having a dramatic effect on the numbers. Thankfully, just this morning, the 7-day moving average of people dying from COVID-19 fell below 1,000, and I think it's going to fall a lot more in the weeks and months to come. So there are some worrying things with regard to variants and so forth, but we do think that we will get a lot of Americans vaccinated, and we also have, frankly, plenty of residual resilience now to this COVID-19 virus because of the number of people who've been infected. I mean, if you had the choice, you should always take the vaccine over the infection if you possibly can, because it's not an easy way to get immunity. But we have a lot of people who've done that too, or who've unfortunately caught COVID-19 over the last year. So you put those two things together, it looks like we're marching quickly towards herd immunity. And so I believe that by the start of the summer, we will effectively have achieved herd immunity, and a lot of things in this country are going to start reopening, and reopening fast. The reopening on its own would have caused very dramatic economic growth, because there are a lot of things like restaurants and travel, which you can really pretty much reopen pretty fast, and that's going to happen. But in addition to that, you've got the massive stimulus just passed by Congress and signed into law by President Biden. And this money, the stimulus checks, the extra unemployment benefits, the money for vaccines and for schools and for state and local governments, that's going to be powering the recovery too. So, last year saw the sharpest recession we've ever seen in the United States in modern history. This year is going to see the sharpest recovery. And I think that, by the end of the year, we're going to be looking at about 7% year-over-year economic growth. We think unemployment will come down well below 5% and still dropping fast. So I think the outlook for the rest of the year and into early next year is actually much more positive. And I think things will be getting a lot better and a lot stronger in the economy in the months ahead.
Good. Yeah. I mean, it definitely seems like there's this very potent mix out there of monetary policy and fiscal policy that are finally in alignment with each other. So that kind of makes me pose the question, with your kind of prognosis for the economy and how good a shape we could be in by the end of the year. How long can the Fed really maintain this very dovish stance that's kind of underpinned this equity market advance? Like, what do you expect out of the monetary policy in the upcoming year or two? And then also on the fiscal side, and I'd kind of throw one more at you in terms of like, what do you see coming down the pipe on taxes? That's something that's on the forefront of our clients' minds. Should we be penciling in a corporate hike, a change in capital gains rates, personal income tax rates, anything like that? So kind of a broad ranging question, but the monetary and fiscal, I think, has been very important in this recovery.
Sure. Well, let's start with the Federal Reserve first. So the Federal Reserve met last week, as you know, and they put out new forecasts, and they do expect economic growth of 6.5% year over year by the fourth quarter of this year. They expect to have inflation up at about 2.5%. They expect to have an unemployment rate down at 4.5%. So these are very positive numbers. But they still say that with all of that, and with the economy continuing to recover in 2022 and 2023, that they still don't think that they're going to raise the federal funds rate until at least 2024. At least that's what they say. Now, to be honest, I don't really think that's what they believe. I think they're caught in a tough situation. They don't really want higher long-term interest rates right now. But if they express too much optimism about the economic outlook, that's exactly what they may end up with. So they greatly believe in forward guidance and trying to lead the market by what they say. So what they're saying is, well, yeah, we think things are going to get better, but we're not going to raise short-term interest rates until 2024. That's what they said on last Wednesday, and I think that's an attempt to hold down rates. But I do think that they're not going to be able to stay dovish as long as they're pretending they're going to stay dovish. And I think if the economy rolls out either the way I'm looking at it, or in fact, I think the way they're looking at it, I think in either case, it's really not that different. I think you will see the Federal Reserve raise short-term interest rates by early 2023 at the latest. But there's another important point, though, which is very important for investors, which is right now the Federal Reserve is buying $1 trillion per year of Treasury bonds, $1 trillion, and then they're buying another $500 billion of mortgage-backed securities. How long are they going to keep doing that? Well, what they've said is that they're going to continue to buy these bonds at least this pace until they've made substantial further progress towards their goals of maximum employment and inflation at 2% and on track to stay above 2%. The interesting thing about that is that if you look at their forecast for the end of this year, which were significant upgrades from what they saw in December, you could make a very strong argument that by early 2022, less than a year from now, they will have made substantial further progress in getting to full employment and getting inflation above 2% and staying above 2%. And I think that's what they will recognize at that point. And so I think that they will then begin to reduce their bond purchases. They'll taper their bond purchases for the rest of 2022, maybe starting in April, say. I mean, these are just what I'm sort of penciling in right now as a forecast. But I think they'll start tapering those bond purchases, and that will also tend to put upward pressure on long-term interest rates. So even though we don't think short-term rates are going to go up anytime before 2023, we do think that long-term rates, which have gone up a lot, I mean, they're up about almost 1% since the election, I think they'll go up some more in the year ahead. And then on fiscal policy, well, you've seen the Biden rescue plan has been signed into law. The next part is the tough part from a political perspective, because the Biden recovery plan, which involves a lot of investment in infrastructure, and of course we've been told about infrastructure for years, both rebuilding bridges and so forth, and then also green infrastructure, which might be better in terms of our climate goals. We've been talking about that for a long time, but the question is always, how do you pay for it? Now, you could pay for it by just borrowing the money. I mean, that's what they've done with COVID relief. But there's a limit to what you can do to that, I think, down in that path while not pushing interest rates higher. It's also possible that they will try to raise taxes to fund this. The problem is it's very hard to find people in the Senate or the House who will agree to raise taxes to fund anything. So even though President Biden proposed raising taxes on individuals earning more than $400,000 and raising the corporate income tax rate from 21% to 28%, there may not be 50 votes in the Senate or 218 votes in the House to do that. So I think it's a very close call as to whether we do get a tax increase. And I think if we don't get a tax increase, in 2021 or 2022, then you have the 22 midterm elections. Quite possible the Democrats will lose their majority in the House. Frankly, the party with the White House normally loses seats in a midterm election. So we may not get a tax increase over the next year. I think it's a very, very close call. And I think if we do get a tax increase, it will be limited to corporate income tax, perhaps the state tax, and those individuals earning over $400,000 a year. So I do think that's how it will be limited. But that of course may well, affect, it will affect plenty of people. But I would call that a close call whether we're going to see that tax increase. The last thing I would say though on this is, if we don't, and if we run big deficits, there is a danger that when interest rates rise, the government's going to have a much harder time financing their deficit. And so if we don't get higher taxes today, there is a significant danger of significantly higher taxes in the middle of the decade when the government might find itself in some distress in terms of financing the debt.
Yeah, those are great points. And I think you mentioned that American Rescue Plan. And one of the things that's kind of interesting about this recent package, it's a rather large price tag. I think it was $1.9 trillion. It's odd that we're speaking in trillions like it's nothing these days, but a $1.9 trillion package, and it's passed at a much different stage, economic stage, than the CARES Act a year ago, right? Maybe it's more similar to the Tax Cuts and Jobs Act in that way, in that it was enacted when we're actually in an expansion rather than a recession. Maybe there's no precedent to it at all. But one of the things that our clients can certainly kind of sense is that the economy is in a much different place than it was a year ago. And now we've got this new stimulus, and up to the forefront of their mind is bubbling up this thought about inflation, right? So is this going to end up being inflationary? Are we adding too much fuel to the fire, so to speak? And maybe it's not a very simple answer to a simple question, but the question I'd have for you is, will this be inflationary and not transitory inflation, but is this going to produce sustained inflation? And if it will, what can we do about it as investors? If it won't, then also what's kind of the reaction function for investors?
Well, it's an interesting question. So I think we will see inflation bubble up. I mean, I think by April, because of easy year-over-year comps, we're going to be looking at inflation at between 2 and 3% anyway. And then I think that will continue through the end of the year. And I think when you have a surge in economic activity towards the end of the year, you can see everything is in place for higher inflation. I think if you look at oil prices, we're in the 60s as opposed to the 40s, which is where we were last fall. If you look at wage growth has actually been remarkably strong. And one of the things that's going to happen because of this act is this act gives enhanced unemployment benefits through the first week in September. And there is an interesting timing issue there, because those enhanced unemployment benefits, basically you get what you'd normally get on unemployment benefits, which frankly is about half of what you would normally get as you work. But on top of that, you get an extra $300. The thing is that, for the average person who's laid off in this recession, their normal wage is about $700 a week. Their normal unemployment benefit would be about $350 a week. You add $300 to that, and now you're up at $650. So if you are a restaurant, you want to reopen, or you want to set up a new restaurant, you want to hire a whole pile of restaurant workers, you're going to have to be able to pay your workers at least $650 a week to start with. Now, $600 a week is a $15 minimum wage. So if you think about it, even though we didn't pass an official $15 minimum wage, it's going to be darn hard to hire anybody over the summer for less than $15 an hour. And so I think you get that you'll get a wage kick, you get an oil kick. You also get there's a supply shortage. I mean, you pray that your dishwasher doesn't break down, because if it does, good luck getting a new one, because there are supply shortages all over manufacturing. What happened during the pandemic is shipping became slower and more complicated, but also Americans bought a whole pile of stuff because they couldn't go out and enjoy themselves. And so we've got this huge backlog of demand for all sorts of goods and parts and around the world. And that's also pushing up price pressures. So we have a lot of things that are pushing up inflation. Now, I think a really interesting question is, what happens in the second half of 2022? I think we're almost guaranteed to have pretty strong inflation going into 2022. But does the economy then slow down enough as we approach full employment to take some of the pressure off inflation? And it might or it might not. I think a key issue here is not so much the tax side of things, but a lot of the programs that were in this rescue plan. There's some of it, obviously, the unemployment benefits, the one-time checks go away, but there were other things like an enhancement to the earned income tax credit, increased child care tax credits and child tax credits, a lot of money for state and local governments. If this money continues to flow through the economy, if some of these tax breaks are extended, then you could have an extension of this extra demand in the economy, this surge in demand in the economy, and that could keep inflation motoring forward at 2 to 3%. I mean, if you go back over the last dozen years, I remember, ever since the great financial crisis, I think it was Mohammed Al-Aryan who came up with the phrase "the new normal," and a new normal was one where you have low inflation and low interest rates. We could be, jolted back to the old normal of inflation of 2 to 4%. Just by the power of this fiscal stimulus in a recovering economy. And I think that's quite possible. I think it is less likely that we'll have an explosion on inflation to the upside, but that's a risk. There's an awful lot of money being printed. There's an awful lot of demand. At some stage, somebody's got to, this economy's got to slow down a bit as it reaches this. And it's funny to talk about this because the economy isn't growing fast right now. It's just what we think is going to happen. It's kind of like you're looking at a hurricane out in the Atlantic, and it's awful calm right now, but you can see this thing coming. And so you need this economy to slow down a bit, or else you might have a more significant inflation problem. What to do about it? I think, is check valuations. Check valuations, because there are a lot of, for example, large cap growth stocks, which have got very high PE ratios. You've got a PE ratio of, say, 30 times earnings or 35 times earnings. those types of stocks ought to be very sensitive to long-term interest rates, because most of the value of these stocks depends on cash flows years into the future. And when you try and figure out, well, what's that worth now, it depends on interest rates. So I think growth stocks are somewhat sensitive to this. Of course, bonds are sensitive to this, particularly long-term bonds. So I think those are areas that I'd be careful about. But also, I think there are some areas that could benefit. Real estate, I think, will do very well in this environment. I think some alternative assets could do well, and I think some commodities could do well. And I think stocks overall, value stocks, particularly financial stocks, could do fine in this environment. Stocks are technically a real asset rather than a bond. I mean, they do the earnings of these companies will go up in an inflationary environment. But I just be very careful. Look at the valuation of everything I own, because I think those things which have the highest valuations, those things which have got the most bubble and froth underneath them, I think they are most vulnerable if we had a high inflation environment.
That's an absolutely perfect segue, because the next thing I was going to ask you is on that more granular equity market investment front. I was just taking a look at some of the one-year gains in the market today, and obviously a year ago marks the low from the pandemic sell-off. And to say what a difference a year makes is probably the understatement of the century, right? But you consider that the S&P 500's returned 79% off the low. And when you get more granular, though, it's interesting to note that small cap stocks have done even better than that. They've returned like 129, 130%. And more recently, probably in the last 3-4 months here, value stocks, like you were mentioning the financials, so particularly some of those more cyclical sectors, have been perking up, and you've seen a little bit of strain on some of the mega cap growth stocks. And we've seen, you just kind of get used to this dominance from those domestic mega cap growth names like Apple and Amazon and Facebook, and Microsoft, Google, names like that. But they have been somewhat weak over the past 3 months. And so I guess the question is, it may sound like your answer is yes, but I don't want to put words in your mouth. Do you think that that can persist? That specifically like the cyclical value sectors of the market, maybe down the cap spectrum, or I'd even throw like international shares in there. Do you think that leadership switch from the mega cap growth stocks to those other areas of the market is sustainable?
Yes, I actually write an article for LinkedIn every week, and I wrote about that just this morning. I think that this rotation has got room to run. First of all, I mean, I think the first part of this, the biggest catalyst of this is interest rates themselves. And yes, we've seen a big rise in long-term interest rates. Have gone from about 0.7% just after the election to about 1.7%. So that's a big move. But still, if you think about it, is 1.7% really a high interest rate on a long-term bond? I mean, over the next 10 years, if inflation is more than 2%, or if it's even 2%, you're losing money in real terms. I mean, if you think about that, that's an extraordinary thing. I mean, what you're saying is, I remember when I was an undergraduate, I remember doing sort of the microeconomics of all this, and the idea is that people are greedy. So I like to eat stuff. So for example, I like eating muffins. But you tell me, well, I'll give you 11 muffins in a year if you don't eat 10 muffins today. Okay, maybe I'll do that. But what's the government saying right now? If I give the government 10 muffins now, it promises me that in 10 years' time it'll give me 9 muffins back. I mean, that's what a negative real interest rate is, and it makes no sense. So these are very, very low yields by historical. It's only by recent history, only by the very recent history, that seems like a reasonable area, or a reasonable place to be. So the first thing I'd say is interest rates are still too low based on where the economy is, and particularly based on where the economy is likely to be. And so I do think you'll see, and I think, this expansion, we're talking about it in prospective terms, but I think not everybody's bought into it yet. Not everybody's feeling it yet, of course, because, most people still haven't been vaccinated. But if this occurs, I do expect that long-term interest rates will move up some further. And I think that will, that power that we will see in a growing cyclical recovery should help small caps more than large. and it should help value stocks more than growth. The biggest industries in value, particularly financials and industrials and energy, should all benefit from stronger growth and rising interest rates. And I think it should also, over time, as the U.S. economy slows down again, if you look at international, I think the rest of the world will boom also. And I think that you'll see international outpace the U.S. But the one other thing I'd say is, so I think I can see the momentum continue at least for the rest of this year until people have fully priced in the extent of the economic recovery. But then the next thing is, if you just look at valuations right now, I mean, what you say, of course, about value versus growth is absolutely true, but it's still the case that right now, the current PE ratio for large cap growth stocks is 155% of its 20-year average, while the current PE ratio for small cap value stocks is only 116% of its 20-year average. So even after this extraordinary surge in small cap stocks, small cap value stocks still look cheaper, and that's true for value versus growth. Value overall still looks cheap relative to growth, and international stocks still look cheap relative to U.S. stocks. So I do think this rotation probably has room to run here.
Yeah, very good. Yeah, and if that inflationary environment does actually, it's a decent way to hedge it. I mean, I think the small cap value is going to be more cyclically oriented, more of your regional banks, that type of thing. So I think that's all kind of in alignment. One more question for you, and then I'm gonna go to some of the Q&A. We've had some really good questions come in, but this is kind of a beast of a question, if I can prep you for that, Dr. Kelly. Is I've mentioned that the market rallied a lot off of the low, 79%. And some of these well-known money managers that we see on CNBC a lot are pounding the table that we're in a bubble, that this is not going to end well. And I guess the question would be, do you think that we've reached that stage of irrational exuberance here for the broad stock market? And then also, what about some other assets like cryptocurrencies or the housing market, or these so-called special purpose acquisition companies, these SPACs?
Yeah.
Anything like that? Does anything out there stand out as bubbly to you? And then also, as a corollary to that, is there anything that maybe does look pretty speculative excess, but could end up being a trend that has some staying power? Maybe the price needs to correct a little bit, but it's a technology that's here to stay. So you can kind of take that any direction you want, but certainly the bubble term has been thrown out quite a bit.
Yeah, and it's a fair question, and I think the short answer is that what we have seen is a big increase in valuations, and the problem with high valuations is it means low returns in the long run. The literature is and the charts are kind of silent on exactly how you get those low returns. Maybe you get weak returns for a number of years, maybe you get a huge correction and then things start to recover. But I do think starting from here, you're likely to get low returns on both stocks and U.S. stocks and bonds over the next few years. I think that is very likely. Is there a general bubble? I think there is sort of a general bubble in that really for the last 40 years, my entire investment career, I've watched people, pour money into equities, into bonds. And so if you go back, say, to the 1980s, really since the 1980s, on average, the stock market has done better than the economy, and the bond market has done better than the economy. And so the total wealth has gone up a lot more than the output of the economy. And so I think there is sort of within that kind of a generalized bubble. And so what you have to do then is sort of pick the market apart and figure out, well, what are where's the bathwater and where are the babies here? And I do think that mega cap stocks, the top 10 companies in the S&P 500, do look more expensive than the other, 490 odd companies. So I think, you want to be, try to not be too exposed to those mega caps. I think that, Bitcoin doesn't make any sense to me. I've been studying money and credit and banking and finance my whole life, and honestly, it's like the emperor's new clothes. There's nothing there except that a lot of people believe in it, and that belief is a fickle thing, but there's nothing backing it. and it is actually nonsense because it's not a currency either. You can't really use it. It doesn't, because it's not stable. So I think people have to be very, very careful about that. I mean, if you have some what I call Vegas money, you would have gone to Vegas for a vacation and you didn't this year because of the pandemic. Maybe you put that into Bitcoin, but I wouldn't put any serious money in there because there's absolutely there's nothing to say that Bitcoin is worth more than a price. I realize it's at $50,000 a Bitcoin right now, but there's nothing about it that tells me that it's actually intrinsically worth more than a cup of coffee. And I think that's a dangerous thing. So there are areas of bubble. I mean, I'm not going to talk about individual corporate names, but I think you know which ones they are. If you look at valuations, you think about, well, how could this company reasonably earn enough money over the long run and return to shareholders to justify its price? And there's some very big names for which that's a very tough question. On SPAC, special acquisition vehicles, basically, or ways of bringing a company to market, I think, to be honest, are a bit of a regulatory dodge. I'm sure people from my investment bank could strangle me for saying this, but I mean that is what I mean. They clearly are they have a lot of advantages. If a company wants to come to market, you don't have to go through all the sort of filings that you would normally have to do. You can be a lot looser in terms of your projections of what your company is going to achieve, and then the initial investors in the SPACs have a way of getting out. Just as the enthusiasm is building among the general public. We'll see how it goes. I mean, I wonder what the long-term regulatory environment is going to be for these companies, and whether the regulators are going to toughen up on this as a way of bringing companies to market. But again, I would just urge people, whether you're, if you're investing in this space, if you're buying a company that's brought to market via SPAC, then just make sure you know what you're buying. Make sure it does actually make sense based on the economy, not based on what everybody else's tastes are today, because those tastes can flip on a dime. What's the company actually worth? I think people need to ask those questions. And frankly, that's what's not going on in a lot of cases, whether it's Bitcoin or some of these mega caps or SPACs. I think a lot of people are just caught up in the enthusiasm of markets, the money that's pouring into markets. And that, some people will end up getting burnt. So again, as I said earlier, I think valuations are absolutely key here. You've got to make sure that what you're buying is actually worth something.
Yeah, that's great. I mean, we talk about when we start taking a look at kind of bubbles, I fully agree with that. Valuations they give you great insight into what to expect in the next 10 years for your total annual return, but they don't do a great job of telling you the path that the market's going to take to get there. And there's a number of different paths, and I've been pointing to, you just look at the rally that we had in 2009, and in 2009, 2010, you got quite a bit of PE expansion in the first stages of those rallies before earnings had a chance to recover. And that's kind of a major difference to something like the early 2000s market top, where you were actually buying peak earnings for peak prices. Today you're paying a lot for future earnings, but you're buying at an earnings trough rather than an earnings peak. So there's quite a bit of difference in that environment from a fundamental perspective. So we got some really good questions, and I think one of the questions that we didn't address directly was in the bond market. So somebody sent in the question if the Fed is successful in sustaining inflation above, their 2%, 2.5% targets. How long does it take rates to, how much pain does a treasury investor have to feel before they're actually getting a positive spread on a real basis, before they actually get a real return? How long does that process take? What can we expect in the bond market? And then I'll add on another layer to that is, what do you see attractive in the bond market today, if not treasuries or municipal bonds?
Yeah, so I think that it will take a lot less time this time around to get to more reasonable interest rates than it did in the last long expansion. So the last long expansion took 10 years to get the unemployment rate down from 10% to 3.5%, from October 2009 to October 2019. This time around, the unemployment rate got up to 14.8% last April, so not even a year ago. Got up to 14.8%. It's now down to 6.2. We think it'll be down to about 4.5 by the end of this year, down to 3.5 by the end of next year. So it's a very fast economic recovery, and that'll probably have the impact of pushing up interest rates faster than you would have seen in a much slower, more pedestrian recovery, with a lot of people worrying about the pace of the recovery. So I do think those rates will move up faster. How much pain you have to endure depends on the duration of the bonds that you hold. I mean, it's you don't, so long as you're relatively short duration and are not really trying to make much money in the bond market through yield, then you don't necessarily get hurt too much by that move. And in the long run, bond investors will be benefited by having higher rates. It's just you don't want to have too much of a capital loss in getting there. And then if you look across the bond markets, there are areas that look a little bit more attractive. I think one area that I look at is emerging market debt, where the spread to U.S. Treasuries is still reasonably high. Now, the U.S. Treasuries themselves are pretty low, those rates, but the overall debt is those yields are relatively high. And then I would, if I had to pick a subset out of that, I think it's interesting looking at Chinese interest rates, which are not very correlated with the U.S. interest rates, but are higher. And this is kind of a new frontier in bond markets. But you can get better yields in China than you can get in the United States. So that's one possible way of playing the fixed income markets. But I think the first thing I would say is you need to be cautious in fixed income, keep durations short, and try not to be overweight the sector overall or the asset class as interest rates go up. But I also, I don't want to give people the impression, just because I've got sort of strong opinions on all these things, that we know the day or the hour that all these markets are going to move. We don't. I mean, it's the history of the last 25 years is of one shock after another that we couldn't have predicted. We couldn't have predicted 9/11. We couldn't have predicted the subprime crisis was going to turn into the great financial crisis, and we couldn't have predicted the pandemic. And I think it's always important for us to remember to be diversified, because you don't know where that next shock is coming from. I mean, I've got a very optimistic view on the economy and the pandemic this year, but it would take one headline of, say, the Norwegian variant has emerged and nobody knows how to deal with it, and suddenly all that begins to crumble. So I think people need to be diversified and have money in fixed income in case something goes wrong, even though we do expect that overall things will improve and interest rates will probably rise in the year ahead.
Yeah, I like to say diversification is our humility in admitting that we don't know the future. The future's unknowable. Yep. And I think that's a great point and something to always keep in mind. I will move on to another couple questions. One of them that's kind of open-ended that I know I always really like to ask folks is, it's actually maybe two questions in one, but it's, what do you see as the biggest risk out there that people aren't accounting for or don't have their eye on? And then parallel to that, what is your view? What's the JP Morgan view and the Dr. Kelly view that you would consider the most out of consensus right now? So maybe a two-part question.
I think they may have the same answer, which is the thing that scares me the most is not so much the growth in government debt during the pandemic, but the change in the political structure in Washington, by which we've basically got populists on the right and populists on the left. And I will admit a bias here that I'm not much of a populist. I think populism is when you sort of switch off the left side of your brain and you just go with bumper stickers and slogans. And I do think you have to think about the reality of how the economy and finances work. But I think that populists on both the left and the right have tended to say, well, we don't have to worry about deficits. We don't just run these big deficits because either the economy is going to grow great or deficits don't really matter. But deficits do matter. And I just worry that there'll always be a reason why we have to have bigger deficits. There'll always be a reason why the Federal Reserve has to increase its balance sheet. And I think over time, we are building up a huge mountain of assets and debt relative to the size of the economy. And the thing that worries me about it, and maybe it's because I read histories of great financial booms and busts, is that if you think about it, if I own a stock or a bond or even have money in a checking account, for me, what that is a coupon. It's a coupon that entitles me at any point that I want to go out and buy goods and services in this economy. But we've seen an enormous pileup in the value of all these coupons. I mean, back in the 50s and 60s and 70s and 80s, the total value of all financial assets in the United States was about 2.5 times our annual GDP. It's now 6 times our annual GDP. And there are a lot of very rich people sitting on an awful lot of assets. And they think that in the back of their mind, they think, well, anytime I want to buy a house or buy a car or buy a stake, I can do that. The problem is that at some stage, this pileup and this growth in assets has to come to an end. And I do worry that, of course, it's being encouraged by these big deficits. But if at some stage you see either money being given from the rich to the poor and the poor spend it, and that causes higher inflation, or people just wonder about, well, maybe high inflation is coming, so maybe I ought to buy the house now, buy the car now ahead of that. You could have a sort of return to the 1970s kind of inflation problem. People could lose faith in the federal government and lose faith in the monetary system. So there are scary things where we're pushing the envelope all over the place here, and it doesn't seem to cause us a problem when there's slack in the economy. But I just, my biggest fear is that we don't have the political discipline in this country. There's no center left, there's just sort of populist extremes. I'm afraid that we're not going to have the discipline to rein in the deficit and to rein in and to push interest rates back up to normal levels in time to prevent a bubbling up of a general asset bubble and a general debt bubble relative to the overall economy. So that's my greatest fear. It's also, I have to say, not what a lot of other people talk about. But I just, at the back of my mind, I know this. I've seen this movie too many times in history, and I'm just afraid that we're on a very dangerous path here, and we may need to, at some stage, not necessarily this year or next year, but at some stage, we're going to get a sort of a sad awakening in this and realize the virtue of conservative budgeting again.
Yeah, good. Thank you for that answer. I would say we've gotten a couple questions that have come in, and I kind of threw it out there on housing, and housing prices have definitely been moving higher quickly. New homes are being influenced by tight supply-demand dynamics, and the input costs. You see what's happened with materials pricing for new homes.
Yep.
It's really been an incredible boom in the housing market. So we've gotten questions kind of on the residential side. So what do you see in terms of the future outlook? So we've had this boom behind us. Is that going to continue going forward? What's the fundamental look on the residential real estate side? And then also some questions on the commercial real estate side, specifically kind of how do you view commercial real estate when you talk about alternative asset classes, and would you lump that in there as an asset class that is attractive here for you?
Yeah. So first of all, on the residential side, the great attraction of residential real estate right now is that it is a good inflation hedge. There is only a certain amount of land, and that is a valuable asset. As financial assets go up in value, it makes land look relatively cheap. So the price of a house is very, prices of houses have been going up a lot, but not so much as the stock market. So I do think that there's some opportunity there. And if we have low interest rates, frankly, a lot of people are able to finance houses at this price. So I think the residential real estate market doesn't look that expensive to me, despite very good gains in prices. I think it's got some room to run. I think the one thing one sort of fly in the ointment is demographic growth is very slow. The birth rate has collapsed. It was falling anyway in this before the pandemic. It's collapsed recently, and one of the big motivators for people buying a house out in the burbs is they have children, and there's going to be, there's a lack of that. So I think that's going to slow down the demand, and also immigration has fallen a lot during the pandemic. So if we get back to a more normal birth rate, more normal immigration, then I'm pretty optimistic about residential real estate going forward. But I think that there is a demographic question there. On commercial real estate, I think it's very idiosyncratic. I mean, I think there's certain things, strip malls with are going to have a tough time because they're always fighting against Amazon, and that's only going to be made worse by the pandemic, has been made worse. And there are a lot of shops that have been shuttered in this pandemic that are never going to reopen. And I think also it's going to take a while to fill downtown office space. I do think people are going to want to get back to the office. I think people have had sufficient of all being, hiding away with their families out in the burbs. I do think there'll be people who want to get back to the office, but companies are always looking for ways to save money. And what they found is they can operate a lot of stuff with people working from home, and they won't forget that lesson. So I think that's going to make the demand for office real estate soft. But there are other areas, things like data centers and warehouses, which I think will do much better going forward. And I think the hotel business will also do just fine going forward. I think people will again, didn't realize what they were missing until the pandemic hit. I think you'll see occupancy rates rise very rapidly. So I think there are pockets of real estate which will do well. And in general, real estate is one of those alternative assets which does protect you against inflation. And so I think it's, everybody should have within their total, their total wealth, I think they should have a good holding of real estate.
Yeah, absolutely. You'd kind of being able to lock in a fixed cost if you get into an inflationary environment, especially if it's accretive to wages. If that environment's accretive to wages, seems like certainly makes the residential side pretty strong potential inflation hedge. So kind of taking in another direction, we have gotten some questions around the international markets, and this has been interesting. The U.S. has been a dominant market for specifically the last 5 or 6 years, but really since the secular low in stocks in 2009. Yeah. And you see these headlines. It's Europe continues to struggle with their vaccine rollout. The AstraZeneca news there and the vaccine hesitancy in Europe just kind of seems like they just can't kind of get out of their own way. And then in China, it's just going to be it's an emerging superpower, right? And you're going to have these political tensions with China, in the U.S. specifically, but other markets as well. How it just kind of seems like the headlines are kind of steering us towards just staying in the U.S. with our stock investments. What are you seeing internationally, maybe outside the headlines that could be positive? Or maybe your take is, why bother? You should stick domestic. So just kind of open that up to you to see some of your more global thoughts.
Well, the first thing I'd say is I'm glad you put it in terms of headlines, because I'm trying to remember the last time I saw a positive headline about anything. I mean, generally speaking, all media outlets make their money by selling bad news. And, people never talk about international crises, international uncertainty diminishing. It's always international uncertainty rising. So we look at all these countries. Thankfully, my team and the Market Insights team, we actually have strategists on the ground in a lot of, in Europe and in Asia. And so that gives us a better sense of what's going on. So with regard to Europe, yes, they have made a bit of a dog's dinner out of the distribution of the vaccine. I will admit that, but all it is, in fact, if you look at the numbers, is it's about an 8-week lag behind the US. So they've got about 9% of their population has had at least one dose of the vaccine, and we're at 25%. But in fact, we were at about 9% 2 months ago, so they're not that far behind. And I think they have some problems with AstraZeneca, but I think they've got they're working off more than one drug, and I think that over the course of the summer they will get vaccinated. So I think that they will reach by the end of the summer. I think things in Europe will be pretty much what they will be by the start of the summer in the United States. Now, that is deeply frustrating for all my European relatives, but it doesn't really change the long-term outlook for the Europe as an investment. And on vaccine hesitancy, there is some hesitancy. It doesn't seem to be much worse than it is here in the United States. It's about the same. The French don't like vaccines, but the Spanish and the Italians and the British are very enthusiastic about vaccines, perhaps because they suffered so badly in this pandemic. But overall across Europe, I think it's about the same. But the key point I'd make about this coronavirus epidemic is that you do get some immunity if you catch the disease, and we think that over 100 million Americans have already caught the disease, and they've got some immunity, and it's so contagious, particularly the UK variant, which is now becoming dominant, that if you don't get vaccinated, you probably will catch the disease. So one way or the other, the easy way or the tough way, I think Europe will march towards herd immunity by the end of the summer, just like we will hit herd immunity, I think, by the start of the summer. So I am optimistic that Europe, having tried everything, having tried every wrong path, will actually end up on the right path with regard to this. And European stocks are cheap, and Europe is quite a cyclical area in terms of the stock market. A lot of luxury good makers in Europe, which would benefit from an economic rebound. And with regard to China, China didn't suffer as much from the pandemic because they locked everybody down. That means they don't actually have, the whole Chinese population is still basically vulnerable to catching the disease. And they are rolling out vaccines of, we don't know what quality because they don't do the same kind of testing that we do. So it's going to be a bit of a struggle for China. It's going to be a struggle for Japan also in getting out of this. But I think that they will get there too, because we do have vaccines which are safe and effective around the world, and this is so disruptive to people's lives that I don't think it's not like the question of, do I get a flu shot every year? I mean, you can get the flu shot or you don't get the flu shot. You get the flu, it's for most people it's not that big an issue, but this one's different. It's affected everybody's life. So I do think the whole world will get out of this at the same time, and I think it's important to look at it from that perspective, because then you can look at 2021 as a very unusual year, but it's almost like, I think, for long-term investing, you ought to start for 2022 and look forward. And from 2022 going on, the US is going to grow slowly because it grew by less than 2% per year over the last 20 years. I think that's its long-term growth path. China's going to grow by more than twice that. India is going to grow faster than that. I think Europe will sort of match the US in terms of growth, but there are plenty of opportunities. There are plenty of great companies around the world, and I think investors need to take advantage of all those global opportunities and not get too caught up in the headlines, because the headlines will always be negative. And the problem is, if the headlines are negative about something in the US, you may know better than the headlines. But if the headlines are negative about the rest of the world, you get very worried. But the truth is, the rest of the world will grow and will recover from this pandemic also. And I think there are plenty of investment opportunities overseas.
Absolutely. I always point to, it's about the growth, right? Growth, the mega cap growth stocks in the US have had a very unique tailwind in that growth has been very scarce for the last 10, 11 years. And they've been able to grow earnings into an environment where economic growth has been very lackluster. But if we're moving into an environment where economic growth is going to pick up, and you get this cyclical recovery and it ends up global in nature, the companies that are likely to benefit that are primarily domiciled in international markets rather than the US market. So investing is all about thinking about what's likely to happen next, not what has happened, right? So thinking about, in terms of maybe one last question, we've got a minute or two here, but you have spent a lot of time talking about COVID and the pandemic, and a number of things have changed, and it'll be interesting to see what changes are transitory and what changes are more permanent fixtures. But it certainly seems like work from home is not going to totally go away. It seems like companies are going to, there's going to be hybrid business models or permanent work from home setups. Do you see anything in that new normal of how we work and interact that has the power to influence the investment markets?
Well, yes. I mean, I think. I mean, for me, it's a little bit odd because I've actually been working from home for at least half of my time for the last 20 years. So this has not been as much of a shock to my work environment as for everybody else. But I think I think first of all, it's going to change how we buy stuff because we've become able to buy lots of things online that we would normally try to hunt down in the store. And while people may like going to stores, some people do, some people don't. The truth is, we've just got much more efficient at just finding ways of buying it at home. I think it's obviously caused a huge change in Zoom in communications, and the advent of video conferencing. It's just taken off in a way that it never would before. So, I used to fly out to the West Coast to talk to to a board or a small meeting, and I don't ever envision doing that again. If it's a big event with thousands of people, yes, but I suspect that an awful lot a lot of business travel is just going to go by the wayside here, because it just doesn't make sense to be flying people all over the world if we can do this virtually. And maybe all of this means a little bit less stress in our transportation infrastructure. I mean, it may be that for a while we will not be traveling as much as we've done either by plane or by car. The rush hour may be less of a strain, and so I think there will be. I think our lives will be changed. I think, and frankly, also there's quite apart from that, there's a lot of. I think there's going to be a lot of emotional damage from this. I think particularly parents who've had small kids at home, it's been just so much harder than I know it has been for me and my wife, because yes, we're locked up at home, but we haven't had to deal with the stress of trying to educate and entertain kids. So it's going to have a profound effect on everybody's lives, and I think sociologists and psychologists will be looking at this for many years to come.
Yeah, absolutely. Dr. Kelly, we are out of time. I think we got through all the questions, but for anybody that's on the line, if you submit any other questions to your representative, we'll make sure to get those answered for you if we weren't able to answer them on the call. I just want to thank you one more time for your insights. This has been great. I've had a lot of fun getting the chance to pick your brain. So certainly appreciate it. And thanks to everybody for taking the time to call in.
Well, thanks very much for the opportunity.